Okay, let's dive into this. You know when you're watching one of those really gripping financial documentary videos about some massive heist, and they start by outlining a scheme so complicated you feel like you need an economics degree just to follow along? Well, when you hear about giant hedge funds pulling the strings of the global economy, it's really easy to assume they're doing something just as elusive. But the truth is, no matter how complex these strategies might seem on the surface, they are absolutely always rooted in the real world and real economies. So, in this explainer, we're going to visually dissect the blueprint of an investor who was genuinely hated by many, yet somehow seemed to understand the world economy better than even the countries themselves. We're talking about George Soros. He achieved an almost impossible level of wealth by following a very specific set of philosophical ideas. And honestly, while academics might still debate these ideas, they really aren't that hard to understand once you break them down.
$1 billion. Let that sink in for a second. George Soros did not make this money over a lifetime of, slow and steady index fund investing. He made this staggering amount in a single trade. By deeply understanding macroeconomic forces, he essentially positioned himself against an entire nation's central bank and walked away with a 10-figure profit. It completely cemented his name in the history books as a true financial force of nature.
And to put that astronomical figure into a bit more perspective, the amount of money Soros made in that one single event was mathematically equivalent to taking $12.50 straight out of the pocket of literally every single citizen in the United Kingdom at that time. It was a financial heist of epic proportions, but it was legally executed right out in the open markets. So how do you actually pull something like that off? It really plays out just like a tense financial documentary video, and today, we're going to uncover exactly how he spotted the fatal cracks in a nation's armor.
Here is our roadmap for the explainer. First, we'll look at the global macro gambler. Then, we'll unpack his core philosophy, the theory of reflexivity. From there, we'll dive into the pound's fatal flaw in 1992, before getting to the climax, breaking the bank, and finally, we'll wrap up by applying the Soros strategy to today's markets. Chapter 1. The global macro gambler. High-stakes speculation.
To really understand this legendary trade, you've got to understand the trader himself. George Soros is not your traditional buy-and-hold investor. At his core, he is a short-term speculator. This means he invests more or less like a gambler sitting at a very high-stakes table, making massive, highly leveraged bets. The engine driving his hedge fund's ridiculous success is called the global macro strategy. Basically, it's a trading style entirely centered around making enormous bets on the broader movements of assets. We're talking currencies, commodity prices, stocks, bonds, all based on deep macroeconomic analysis. So he isn't getting bogged down in the micro details of, say, a single retail store. No, he's looking way up high at the shifting tectonic plates of the entire global economy. Now, what's really interesting about this quote is that it captures the absolute core essence of his entire trading philosophy. Soros says the objective is to ride the economic trends whose premise is false and step off from it before it is discredited. Think about that. He is actively hunting for lies in the market. He's looking for situations where the whole world is buying into a false narrative. He rides the momentum of that false belief, and then he cashes out right before reality inevitably comes crashing down on everyone else.
Chapter 2. The theory of reflexivity. Two realities. So how do you spot a false premise in the wild? Well, Soros developed this unproven but highly effective philosophical idea called reflexivity. It's based on a pretty fascinating view of the world. Reflexivity argues that human perception of reality is always biased. Soros believed that we can never truly perceive reality perfectly. And because of that, our actions are always skewed. So our biased actions cause our subjective reality to drift further and further away from objective reality. And that gap, that divergence, that is exactly what creates market booms and busts. To make this crystal clear, Soros basically says there isn't just one reality. There are two. You have objective reality. These are the hard mathematical facts of an economy that simply cannot be influenced by humans, no matter how hard we try. And competing directly with that, you have subjective reality, which is what humans believe is happening. And this can be deeply influenced by our biases and actions. The friction between these two things, between cold, hard math and human belief, is exactly where the really big money is made. Let's walk through how this builds in a real-world scenario, like real estate. Step 1, the market expands. Totally normal, right? But then in step 2, that human bias kicks in. people start to perceive the market as being way better and much safer than it objectively is. This subjective belief causes actual physical action in step 3. Developers start building more and more houses, pushing further out until the sheer amount of housing produced entirely outpaces what the population actually needs. And finally, step 4. That subjective illusion shatters against objective reality, and the boom turns into a brutal bust cycle. Soros looks at this irrational behavior not as a tragedy, but as a massive investment opportunity.
Chapter 3, The Pound's Fatal Flaw. Setting the stage in 1992.
Now we're going to apply Soros's framework to the British economy in the early 1990s. Back in 1990, Britain entered the European Exchange Rate Mechanism, or the ERM. The whole goal here was to keep their currency, the pound, artificially propped up and pegged to the strong German mark. But as we rolled into the early 90s, objective reality set in. Britain's economy fell into a recession. Naturally, to stimulate the economy, they had to start printing more money. And as we know, printing money inevitably causes a currency to depreciate. Yet, in 1992, the British Prime Minister John Major completely ignored those fundamentals. He stubbornly insisted on keeping the sterling's position in the ERM artificially high. And this brilliantly illustrates the massive disconnect Soros spotted. Just compare the two countries. On one side, you have Germany's objective reality, lower stable inflation, a normal cash supply, and a natural currency value. On the other side, you have Britain's subjective policy, an inflation rate that was many times higher, rapid cash printing, and yet they are stubbornly insisting on keeping their currency artificially pegged at 2.7 German marks to the pound. I mean, think about it. They were adding cash to their economy way faster than Germany was. Forcing that exchange rate to stay at 2.7 was objectively a terrible idea. It was a textbook false premise, and George Soros was watching the whole thing unfold. Chapter 4, Breaking the Bank, the climax of 1992.
The tension between Britain's fantasy and the market's reality was about to snap. When the British government decided to actually raise interest rates in a desperate attempt to stop the mounting pressure on the sterling, Soros knew they had just made a fatal error. He told his partner right then and there that this was the wrong policy for the long term. It simply wasn't sustainable. Because the underlying economics were so fundamentally unsound, Soros realized they could sell any amount of sterling and the government just wouldn't be able to maintain that peg. His reaction was incredibly predatory and decisive. He said, "I said go for the jugular, go for the kill."
The events that followed played out with rapid-fire chaos. Soros, along with a group of other speculators, began massive, aggressive short-selling of the pound. The sheer volume of this selling caused the exchange rate of the pound to depreciate violently. The UK government went into full panic mode. They burned through almost $26 billion of their own currency reserves just trying to buy up pounds to stop it from dropping. But they couldn't fight objective reality forever. They couldn't stop the pound from depreciating across multiple currencies. Finally, after losing billions of dollars, the UK government caved and withdrew from the ERM. Now, despite the legendary myth of George Soros single-handedly destroying the Bank of England, his own admission about the event is incredibly revealing. He later stated, "I was only one of many market participants that was selling sterling, so I did not really break the Bank of England. I just became identified as the embodiment of the financial markets." He knew for a fact that if there were a ton of other people doing the exact same thing, it wouldn't have worked. The fundamental economics simply took hold, forced the depreciation, and Soros, he was just the most visible surfer riding a totally unavoidable wave. Chapter 5, Applying the Soros Strategy, Lessons for Today. So the crucial point is this. Yes, a pure global macro strategy is incredibly hard for the average everyday investor to replicate perfectly. We don't exactly have billions in leverage lying around to force a country's hand. However, you absolutely can learn to spot irrational behavior in modern markets, just like Soros did. Because countries aren't the only ones that exhibit this kind of irrationality. Companies do it all the time. Keep your eyes peeled for companies taking out excessive, really risky loans to fund fundamentally bad projects. When you spot a company whose subjective reality, basically what their CEO is hyping up on earnings calls, completely ignores the objective, fundamental economics of their balance sheet, you have an opportunity. That's when you might look at selling short on the company's stock or maybe buying a put option so you can profit when reality eventually hits. You just have to learn to look for that divergence between what people fiercely believe and what the math actually says. It happened in Britain in 1992, it happens in every major real estate cycle, and trust me, it is happening in the corporate world right now.
Which leaves us with one final, pretty essential question to ask as you look at your own portfolio. Where is the market acting irrationally today? Find the false premise, and you just might find your next great trade. Thanks for joining me on this explainer. I'll see you next time.